Welcome back to the final episode of AKC Capital's financial podcast series for the month of August. As we conclude this month's theme, equity markets and long term wealth, today's topic for discussion is asset allocation. How to divide your investments smartly. We have heard the saying, don't put all your eggs in one basket. But when it comes to investing, what does that actually mean? Today, we will understand how to divide our investments wisely to build a stronger portfolio. Welcome, Aditya.
Thank you.
Let's start with the basic question. What is asset allocation and why is it so important for every investor?
Well, so thanks for having me for another session. So basically, asset allocation is how you divide your money or investable surplus across asset classes. So what are the common asset classes in India? It could be equities, it could be fixed income, it could be alternate assets, and commodities, gold oblique silver, and cash, right? Which is the proxy, or for which liquid funds or short-term funds could be the proxy. So this is basically allocating to each of these buckets depending on one's investment goals and risk appetite. And statistically, we have seen that in 91% of the cases, or 90% of the returns actually come of a portfolio come from the right asset allocation, right, over a longer period in time, not from individual stock selection. So it is very important that we pay adequate attention to this, and this will go a long way for an investor to have better risk-adjusted returns in their portfolios.
So, my next question to you, what is the right equity to debt split for my age?
Right. So I think that's a good question. So the rule for allocating to equities would be 100 minus your age. So let's take an example, a person who is 30 years of age, for example, right? So he or she could allocate 100 minus 30, which is 70% to equities, right? Similarly, a person who is, let's say, 60 years of age would be doing 40% allocation to equities. So the point here is that the younger you are, you have more time for your equity investments to grow, because equity investments generally need a longer time horizon to grow, generally 5 years plus. So generally, a person who is, let's say, 70 years of age, which will have very lesser time, in terms of life expectancy for letting his or investments to grow. So for him, the allocation to equities would come down to 30% or below. So this is one simple rule which is good for retail investor to get started with. But a lot more depends in addition to this rule, and this could be your financial goals. It could be your risk tolerance levels as well. And third could be even your behavioral or your behavioral traits, right? I may say, for example, I'm an aggressive investor, but when from a behavior point of view, I may have a contradiction or a completely different personality. So you have to look at all the three components: your goals, the times attached to reach these goals, the risk tolerance, and also the behavioral aspects or traits of an investor. These actually go a long way to determine the right asset allocation to equities and other asset classes.
So, we would like to understand, how does gold fit into an investment portfolio?
Well, I think this is a good question. So the way I would like to answer is that first, gold is traditionally a portfolio stabilizer, or it's a hedge when the markets are going down, because gold statistically has a negative correlation to equities. So when the markets and there is global uncertainty, gold tends to do well. It move in opposite direction. That is called negative correlation. So we always say that in a client's portfolio, around approximately around 10% of allocation could be done to gold, which will go a long way in stabilizing the portfolio. The other thing you would like to look at is how you could invest in gold. Well, in today's markets, there are plethora of options. The most common has been moved by the government, which is your SGBs or the sovereign gold bonds, which typically come with a lock in of around 8 years, and the returns are tax free at maturity after 8 years. Plus, you get an annualized interest of 2.5% as well. You could also participate by investing through gold mutual funds. Mutual funds are so accessible today, and you could select a good gold mutual fund where the underlying is a gold is gold itself, and start building your portfolios. You could also buy ETFs which are done through your demat account. So you see there is a lot of these options available. I think these help you to lower your costs because you are not physically storing gold in a locker or at home. So obviously you save a lot on storage costs. There's also the safety aspect, right? Your investments are safe because they're all digital and online, and you can liquidate them whenever the family needs it in future. In India, typically gold is also important element to look at where you need it during children's marriages, right? So it also has a very strong emotional connect as well. So it's easily it can be easily liquidated whenever the family needs it. So I think this is, in this context, one should look at gold in the portfolio.
And the final question to you: how often should we review and rebalance our portfolio?
Well, this is a good question. So generally, let's say an investor has a asset allocation of 70% in equities and 30% in debt, fixed income. So we generally tell clients that whenever you drift away 10% from your core asset, you should rebalance your portfolio. So let's say the markets went high and 70% become 80%. So you can then sell off your equity so that you come back to a similar allocation of 70%, right? And the opposite also true when the markets tend to fall. In that case, your 70% has become, let's say, 60%, and you would like to invest more in equities, so you're buying low to add to your equity portfolio. So this is largely in line with strategic asset allocation, which is your core asset allocation, which we've agreed on. The other element could be also tactical asset allocation. So this could happen when you want to take opportunistic calls, right? You may want to buy at certain price points where market will give an opportunity to make a quick return, and this could also determine how you would navigate and do your change your asset allocation. But generally, we feel that the portfolio rebalancing, in addition to these market shifts of around 10%, can be done once in a year, or annual rebalancing has to be done. And we see that when you do your annual rebalancing of your portfolios, this could actually add to 0.5 to 100 basis points to your returns on a longer period in time. So this is where it is. To summarize, whenever there's a 10% drift, change your asset allocation. But if such a scenario does not happen, then anyways look at annual rebalancing.